Hey, welcome. Today, we are going to pull back the curtain on one of the most powerful tools out there for any investor, the mutual fund. In just the next few minutes, you'll get the inside scoop on what they are, how they work, and maybe most importantly, what to ask before you even think about jumping in. So let's get to it. So let's just kick things off with a question. You ever get that feeling that you want to invest, but you feel like you're on the sidelines because, you're not some Wall Street genius or you don't have a giant pile of cash to start with? Yeah? Well, if that sounds familiar, then you are exactly who mutual funds were made for. At its heart, a mutual fund is actually a super simple idea. Think of it like a giant potluck dinner, right? Instead of you having to cook this huge fancy meal all by yourself, you and a bunch of your friends each bring one dish. By pooling everything together, you all get to enjoy this amazing, diverse feast. A mutual fund is the exact same thing, but with money. It takes smaller amounts from tons of investors and uses that big pool to buy a huge variety of stocks, bonds, and other things. Now, you're probably thinking, okay, cool, but who's actually managing all this money? And that is a fantastic question. See, a mutual fund isn't just a random pile of cash. It's a really carefully built machine with very clear rules and roles for everyone involved, all designed to keep your money safe. So let's meet the main players in this operation. First, you've got the sponsor. This is kind of like the founder, the one who comes up with the whole idea and gets the fund started. And they have to have a solid, trustworthy reputation. Next up, you have the trust and the trustee. Just think of them as the guardian of the fund. Their whole job is to watch over everything and make sure your interests, the investor's interests, are protected. And finally, you have the asset management company, or AMC. This is the manager. This is the team of pros who do the day-to-day work of researching and deciding exactly which stocks and bonds to buy or sell. And watching over this entire setup is the ultimate watchdog, a country's top financial regulator. In the US, for example, it's the SEC. In India, it's SEBI. Every single mutual fund has to play by their very strict rules. It's a legal framework that makes sure everything is transparent and gives you a really important layer of protection. Okay, so now we know how a fund is built. Let's start looking at the menu. Because just like when you go to a restaurant, there isn't just one option. There are all different kinds of funds designed for different goals and, well, different tastes. Let's break down the basic choices you're going to see. So the first big decision you'll probably face is this: open-ended or close-ended. And the difference really just boils down to one word: liquidity, which is just a fancy way of saying how easily can you get your money out. Open-ended funds are super flexible. You can buy or sell your units any day the market's open. Closed-ended funds are a bit more rigid. Usually buy in when the fund first launches, and you can typically only sell when the fund's term is over. So the real question for you is, how much flexibility do you need? Next up on the menu, regular versus direct plans. Now, a regular plan is sold through an intermediary, like a financial advisor who gets a commission for selling it to you. And that commission, it comes out of your investment in the form of a higher fee. A direct plan, on the other hand, you buy straight from the source, the asset management company. No middleman, no commission. So the fee is lower. And here's the key takeaway. A lower fee or expense ratio means more of your money stays invested and working for you, which can add up to way higher returns in the long run. Beyond how you buy a fund, you also get to choose what kind of fund you want. Think of these as the main flavors, and each one is a totally different goal. Growth funds, they're all about growing your capital, so they invest in stocks. Income funds, they want to give you a steady, fixed income, so they invest in things like bonds. Hybrid funds do a little of both, giving you a balanced mix. And tax-saving funds, well, they're built specifically to give you tax breaks. Your choice here really depends on what you're trying to achieve financially. All right, we've talked about the structure, we've talked about the different types. Now let's get you fluent in the language of mutual funds. Seriously, if you can get your head around these next three terms, you can pick up pretty much any mutual fund document and know what you're looking at. This is where you really start to feel in control. First on the list is net asset value, or NAV. Put simply, the NAV is just the price of one single unit of a mutual fund. You know how a company has a share price? Well, a mutual fund has an NAV. And because the value of all the stocks and bonds inside the fund changes all day long, the NAV gets a fresh calculation at the end of every single trading day. And if you're curious how they get that number, here's the formula. It's basically the total value of everything the fund owns, all its assets, minus any of its debts or expenses, its liabilities. They take that number and divide it by the total number of units that all the investors hold. It's a really straightforward way to get the true up-to-date market value for each unit.
We touched on this one earlier, but it is so important it deserves its own spotlight. The expense ratio. This is the annual fee you pay to the pros for managing your money. It's usually a small percentage of your investment, but you have to remember this. The lower this number is, the better it is for you. It means less of your hard-earned money is going to fees and more of it is staying in your pocket, growing for you.
And finally, we have the SIP, or Systematic Investment Plan. This is just an incredibly powerful tool for building wealth over time. Instead of needing one big chunk of cash to get started, a SIP lets you invest a smaller, fixed amount automatically, usually every month. It's kind of like putting your investing on autopilot. It builds amazing financial discipline and is one of the best ways to grow your wealth steadily without even thinking about it. So we've covered all the mechanics, but every single investment has two sides to it, the rewards and the risks. To be a smart investor, you have to go in with your eyes wide open, ready to look at both. So let's weigh them up. The good stuff is pretty compelling, right? You get professional managers handling your investments, you get instant diversification, your money is spread out across tons of different companies, which is way safer than just betting on one or two. You've got the potential for solid returns, good liquidity, a transparent and regulated system, and you can get started with a very small amount of money. But of course, there are risks. The biggest one is just market volatility. The value of your investment is going to go up and down. That's just how markets work. If your fund holds bonds, there's credit risk, the chance a company won't be able to pay back its debt. We already talked about liquidity risk with certain funds, and then there's concentration risk, which happens when a fund bets too heavily on just one industry. Now, knowing these risks isn't about being scared, it's about being smart and making informed decisions. And there you have it, the what, the who, and the how of mutual funds. You now have the foundational knowledge to look at the world of investing with way more confidence. The power, truly, is in your hands. So the real question now isn't just what your next step will be, but where you want that step to take you.